Hello everyone. I hope you guys are doing fantastic. Welcome back to my channel Finad with Vikram. In today's world, we get a lot of free advice, mutual fund advices, and we start believing them and take wrong investment decisions. In today's video, we're gonna talk about three biggest myths about mutual fund investing that you thought were right. Let's talk about myth number one. We get a lot of queries from investors asking that what's the NAV of this mutual fund? If it is low, shall we buy it? Will it give us more returns? There is a big myth saying that a mutual fund whose NAV is low is cheap and will eventually give more returns. That's actually incorrect. Let's take an example of two mutual funds, Invesco Focused Fund and Invesco Global Consumer Trend. These both the funds are launched in 2002, and at present the NAV of Invesco Focused Fund is 24.5 and the NAV of Invesco Global Consumer Trend is 8.5, which is of course less. So you might be thinking 8.5 is cheap and Invesco Global Consumer Fund will perform or have been performing. But if you compare the returns of these two funds since inception, Invesco Focus Fund has given 22% returns since its inception. And as compared to Invesco Global Consumer Trend Fund, it's not even positive. So a fund whose NAV is 8.5 has not even given positive returns since inception, but the fund whose NAV is very high has given 22% returns. That says that a NAV is not an exact measure of figuring out the right mutual fund. Moving on to myth number two. This is one of the craziest myths wherein we say that MF with low expense ratio will give better returns. I see a lot of investors buying index funds saying that their expense ratio is low, but they end up losing a lot of good returns as compared to the other funds which are active. Let's talk about two funds. ICICI Nifty 50 Index Fund and ICICI Large and Mid Cap Fund. If you talk about the expense ratio of these two funds, ICICI Nifty 50 expense ratio is 0.36% and ICICI Large and Mid Cap Fund expense ratio is 1.7, which is 4 times more than the index fund. Let's compare their returns. The last 1 year return of ICICI Large and Mid Cap Fund is 10%, and you won't believe that last 1 year return of ICICI Nifty 50 Index Fund is just 2.6% return. So if you talk about the difference, the investor is losing 7.4% extra returns and they are just saving a little bit on expense ratio. So expense ratio is not exactly or not always a better measurement of picking up the right mutual fund. Moving on to myth number three. Myth number three is MF with better returns today will also give better returns tomorrow. I see a lot of investors actually filtering out MFs with best returns and they put a lot of money into that. And they end up losing eventually a lot of money when the fund do not perform. For example, let's take an example of ICICI Tech Mutual Fund. If you talk about ICICI Tech Mutual Fund performance in year 2021 is 75%. And if you are if you are believing into this myth and you start investing that money and think that it will consistently perform, it did not. And the very next year, the returns of this mutual fund was minus 23%. So it's very important that you diversify your portfolio. And when you are investing for long term, you should focus on the strategy of that fund and the fund manager before investing and not just on the returns. These were some of the interesting myths that we wanted to bust. And of course, this could have been an eye opener for you as well. So we'll come up with another video where we'll talk more about myths in mutual fund. Till then, have a great day and happy investing.